Imagine you suddenly had $100,000 to invest. You have two choices. Option 1 is investing the entire amount into the stock market. Option 2 is using that money as a down payment on an investment property. Which option would make you wealthier over the next 10, 20, or even 30 years? It's one of the biggest debates in personal finance. Some people believe real estate is the ultimate path to wealth. Others argue that stocks outperform almost everything over the long run. If you've spent any time researching investments, you've probably seen strong opinions from both sides. So today, we're putting them head to head. We're comparing a $100,000 investment in stocks versus real estate in Canada to find out which one has the potential to create more wealth. The answer may surprise you. Let's start with stocks. When most people invest in stocks, they aren't buying just one company. Instead, many investors choose broad index funds or ETFs that give them exposure to hundreds or even thousands of companies at once. This creates instant diversification and reduces the risk associated with individual businesses. One of the biggest advantages of stock investing is simplicity. You can invest from your phone in just a few minutes. There are no tenants to manage, no properties to maintain, and no unexpected repair bills showing up in your mailbox. Your money simply remains invested and grows over time. Historically, stock markets have delivered strong long-term returns. Let's imagine you invest $100,000 into a diversified portfolio that earns an average annual return of 8%. If you leave that money untouched and reinvest all dividends, your investment could grow to approximately $216,000 after 10 years. After 20 years, it could reach roughly $466,000. After 30 years, it could exceed $1 million. That's the incredible power of compounding. Your money earns returns, and those returns begin earning returns of their own. Now let's look at real estate. Unlike stocks, most Canadians wouldn't use $100,000 to purchase a property outright. Instead, they would use that money as a down payment. Let's say you purchase a $500,000 investment property using a 20% down payment. Something very interesting happens immediately. Although you've only invested $100,000 of your own money, you now control a $500,000 asset. This is called leverage, and it's one of the biggest reasons people become wealthy through real estate. If that property increases in value by just 5%, you've gained $25,000 in equity. That's a 25% gain on your original $100,000 investment before considering costs and expenses. This ability to control a large asset with a relatively small amount of money can dramatically increase returns when property values rise. However, leverage also increases risk. If property values decline, losses can be amplified as well. What helps you on the way up can hurt you on the way down. Now let's compare income. Stocks generate income through dividends. Many Canadian companies distribute a portion of their profits to shareholders, creating passive income without requiring any additional work. Real estate generates rental income. At first glance, rental income often appears more attractive because the cash flow can seem larger. However, owning rental property comes with many expenses that investors sometimes underestimate. Mortgage payments, property taxes, insurance, maintenance costs, repairs, vacancy periods, and property management fees can all reduce the amount of money you actually keep. A property might generate thousands of dollars in monthly rent, but a significant portion of that income often goes toward expenses. Stocks, on the other hand, require very little effort once your portfolio is set up. Dividends arrive automatically, and you don't need to answer phone calls about leaking roofs or broken appliances. Time is another major factor that many investors overlook. Real estate often requires active involvement. You may need to screen tenants, collect rent, coordinate repairs, handle maintenance issues, and manage paperwork. For some people, this isn't a problem. They enjoy the process and see it as part of the investment. Others find it stressful and time-consuming. Stocks are far more passive. You can manage a large investment portfolio with very little effort each month. For investors who value simplicity and freedom, this can be a significant advantage. Another important difference is diversification. If you invest your entire $100,000 into a single property, your success depends heavily on one location and one asset. If that area experiences economic problems or declining property values, your investment may suffer. With stocks, diversification is much easier. A broad market ETF can provide exposure to thousands of companies across different industries and countries. This reduces the impact of any single company or sector performing poorly. Diversification is one of the most powerful tools available to investors because it helps reduce risk while maintaining growth potential. Taxes also play a role in the comparison. Real estate investors often benefit from various deductions related to owning and operating rental properties. Mortgage interest, maintenance expenses, insurance, property management fees, and other costs may help reduce taxable income. Stock investors have their own advantages through accounts such as the TFSA and RRSP. These accounts can significantly improve long-term investment returns by reducing or eliminating certain taxes. The tax winner depends heavily on individual circumstances, but both investments offer opportunities to improve after-tax returns. Now let's imagine two investors. Both start with exactly $100,000. One invests everything into a diversified stock portfolio. The other uses the money as a down payment on a rental property. Both hold their investments for the next 25 years. Both make smart decisions and remain disciplined. Who ends up wealthier? The truth is that there isn't a guaranteed winner. There have been periods where real estate significantly outperformed stocks. There have also been periods where stocks delivered stronger returns than property. Once maintenance costs, taxes, transaction fees, and ownership expenses are fully considered, the difference between the two investments often becomes much smaller than many people expect. The outcome depends on market conditions, interest rates, investment choices, and how effectively the investor manages their assets. This leads to an important conclusion. The debate between stocks and real estate often misses the bigger picture. Both investments have created millionaires. Both have helped people achieve financial independence. Stocks reward patience, consistency, and long-term thinking. Real estate rewards leverage, management skills, and strategic decision-making. Neither option is automatically better than the other. The best investment depends on your personality, goals, and willingness to handle risk and responsibility. Interestingly, many wealthy people eventually stop choosing between stocks and real estate altogether. Instead, they own both. Stocks provide diversification, liquidity, and passive growth. Real estate provides leverage, rental income, and additional diversification. Together, they create a balanced approach to building wealth. One investment can support the other, reducing overall risk while increasing long-term opportunities. So, what actually wins in Canada? Is it stocks or real estate? The honest answer is that both can be powerful wealth-building tools. The investment that wins for you is the one you can stick with consistently through market ups and downs. Because at the end of the day, building wealth isn't about finding the perfect investment. It's about staying invested long enough for compounding to do its work. Whether you choose stocks, real estate, or a combination of both, consistency and patience will always matter more than trying to predict which asset class will outperform next year. If you had $100,000 to invest today, would you choose stocks or real estate? Let us know in the comments below. If you enjoyed this video, don't forget to like, subscribe, and turn on notifications for more Canadian investing and personal finance content. Thanks for watching, and we'll see you in the next video.